So today I wanted to take you through the management accounts. If you are a founder or part of the leadership team and you're receiving these monthly management accounts from your finance function or your CFO every month and you don't know what you should be doing with them and what you should be looking at. So this video is going to assume that you don't have a huge amount of accounting knowledge. I am going to take you through a very basic management accounts example. They're just made up numbers, and I'll go through them step by step, what you should be looking for as a leadership team member, and potentially questions you should ask your finance team, and what you should be getting out of it and why it's worthwhile reading. My name is Alysha Randall from Fast Growth Consulting. I'm a fractional CFO and I focus on seed to about Series B stage businesses, that really early stage business. And I do posts, I try to do them fortnightly, just to help educate founders and leadership team on finance numbers and what you should be looking at and how finance numbers can help you, and also things that you can do or look for to help you fundraise as well. So I'm going to share my screen. Yes, it's going to be in Excel, but this is the easiest way for me to demonstrate. Okay, so as I said, it is in Excel, but it's the easiest way for just do a mock-up for you. I don't think any of our founders would like it too much if we shared live management accounts, but ideally, your management accounts should be in a reporting software such as Fathom. It pulls very easily from Xero and QuickBooks if you don't have a large ERP system. Things that should be included should be commentary, charts, and KPIs, and then the 3 financial statements, a profit and loss, balance sheet, and cash flow. And all of these should be compared to a budget and prior year or prior month financials. Now, if you are not getting those pack like that with the management accounts, I'll leave a link below, a very short and inexpensive course for your finance leader or finance manager, actually, financial controller. Send them that way, and then hopefully they'll give you what you need. So as I mentioned, the first thing should be commentary. These should give actual reasons for there being variances between numbers. So commentary should be things such as, we've missed revenue this much by X amount, and the reason for this is because in the sales team there was problems with the telephone system. This telephone system has now been fixed, and going forward there shouldn't be any problems with hitting revenue for this reason, for example. And the commentary should be the most interesting part of the reporting pack that you get. That should be the first thing you're reading when you're receiving the management pack. That should give you an understanding of how the things potentially in your department have affected the numbers. I mean, you probably already know this, but it's also good to see how all the other moving parts throughout the business also affect the numbers. And then you'll have charts that'll show the North Star, the main things. And then the key metrics that should be included is whether the business is going to hit targets or not. So if one of your big targets for the year is volume based, then the KPI should have that volumes. What is the KPI in my department that can confirm that we're on the right track to hit that target? Ideally, you're getting KPI trends. Now, this is very high level theoretic. But what I really wanted to focus on was the 3 financial statements and what you should be looking at within those. So again, this is an example of what it could look like. And you have 5 sections really. You have the revenue, you have the cost of sales, contribution margin or some sort of other subtotal, your overheads, and then a couple of subtotals at the bottom. So let's go start at the top. Now, revenue is the most obvious one. How much income did you make? And when we talk about revenue in finance, we're talking about how much you've invoiced, how much work have you completed and therefore earned. This has got nothing to do with cash. Cash we'll deal with later. So if you raise an invoice, say B2B, you raise an invoice for £50,000 or dollars, then that would be included in here, whether the invoice has been paid or not. So that's the big distinction between cash and revenue. So see it as, what have you earned? What work have you completed? What service have you provided? So if you're thinking about goods as well, it's thinking about what have customers actually received. So if you sold a product and the customer by the end of the month has got the good in their possession, then you can include it in revenue. If they haven't got the good in their possession, then it will be included in the month that they've actually received the product. So sometimes if you have services that go over a long period of time, you may recognize it in installments, and that'll be part of that revenue recognition element. But just think about, what product or service have I given to a customer this month, and then that would be included in here. Cost of sales are the costs that you have to incur in order to deliver a product or service. So a product is easiest to understand. If, say, for example, product A, in this example, product A is a, I've got a cup here, cup of coffee. Say it's the actual cup. So the revenue would be when I've received as a customer this cup and I've paid, say, $10 for this cup. The cost it costs to either create this, so whether it is manufacturing cost, or you have purchased it from a wholesaler and you had to pay for this inventory, you had to pay for pick and pack, for the actual warehouse to put it into a package and send it to them, and then the postage. That would be your cost of sales. It's the actual cost of getting the cup and getting it to the customer. If it's a service, so say, for example, it's a software service, generally, if the software has already been produced and you have, R&D costs for that, and it's an asset that you keep on the balance sheet, which we'll go through shortly, and you are just delivering this service, it's the cost of actually delivering that service. So if you have, say, account managers that not sell, but actually have to help the customer receive this service, or often with SaaS businesses, the gross margin's quite high because the only thing you really cost is maybe a bit of bandwidth, or maybe, say, merchant fees, the cost of if your customer pays by credit card, you get a fee for that, and that would be included in your cost of sales. So generally, if it's a product, the gross margin, which is revenue minus cost of sales, is quite high. If you're a service business, generally it's the other way around, but that is because quite a few of the things are kept further down. So you're looking at what is the overall revenue for each of the products. You want to look at both month-on-month movements. Have we sold more or less? What is the reason behind that? What the budget is and how much you miss that. Now, sometimes the percentage can be really high, but the number is quite low. And then you may have the flip side. This is one of the higher ones, but it's 15% compared to 355. It's worthwhile looking at both, because sometimes the percentage is higher and the finance is higher. It just depends on the materiality. What's also interesting is seeing it how you did in the same month prior year, and that is showing how you've progressed, how much you've improved year on year, particularly if you're in a business that has quite a bit of seasonality. So if you have a lot of seasonality, that year on year comparison is potentially more interesting than month on month, particularly, say, in December. December may be a really shocking month. In April, you may be booming. So it's always worthwhile looking at that. And then also year to date. So this is saying how much have you made year to date. So obviously in this example, I've assumed that January isn't the start of your financial year. And this is set, then you'll have the budget next to that as well. So you'll know whether you're going to hit budget or not. And the question for you then is, can we increase the next future months so we hit the full year targets? And what should you be potentially changing so that you can? So it's looking at the reasons, the drivers behind these variances, and what can you do to mitigate against that. Similarly, when you're looking at gross margin, you want this number to be as high as possible. And generally, it doesn't move too much when you're looking month on month. I mean, in this example, it is 5%, but generally it's only a 1 or 2%, particularly if your accountants are doing as they should be. But what might be more interesting is potentially looking at year on year or budget. So the budget may have assumed you're going to change something in your delivery so that you have better margins, or prior year you may have better or worse gross margins. And ideally you want better gross margins because it means your every dollar or pound you're selling, more of it stays in your pocket. If it's going the other direction, so like this one, I would be concerned because it means that you're not as efficient. And so it's working out what do you need to do to get to that better level. The next subtotal is generally, not always, but in general, is contribution margin. And what that means is it's looking at variable costs, which means not fixed costs. So fixed costs would be like rent, for example. Your variable costs that you can turn on or off. So marketing is a perfect example. You can increase marketing like crazy, and then you can turn it off if you want. In general, most marketing is month by month. And so this is saying, okay, these costs are variable. So they increase as revenue increases. So more revenue money you spend, the more marketing revenue you spend, the more revenue you get, but not always if your marketing is not efficient. So this is why it's important to keep track of your contribution margin, because you want to check that the money you're investing in sales and marketing is giving you dividends. Not literally, but you know. And so in a startup or scale up, early stage business, you want to be in the black at the gross margin as quickly as possible, probably once you've got product market fit. If this is still in the red after product market fit, you need to seriously do something, because otherwise your business margin is not working. And then the next thing is focusing on contribution margin. Now, what often happens, particularly around Series A, is you've received a lot of money to grow the business because you've got product market fit, and you're trying out different sales and marketing channels to find out what works. I mean, ideally, actually, this is before Series A, but sometimes it's at Series A. And you want this to be in the black also as fast as possible, because then it's saying every pound or dollar I'm investing in marketing and sales, I'm getting money back. So you want this percentage to be as high as possible. Then you have all the overheads that everyone's aware of. So staff costs, excluding your sales and marketing team and excluding your cost of sales. As I said, services, you often don't have many costs of sales. Usually it's goods businesses, you'll have costs of sales. So it's the leadership team, it's the finance team, it's your tech team. Often with businesses, particularly if you're tech focused, we would have the tech team separate. We'd split them out separate because you're investing in tech, and that generally means developers. Professional fees, that's consultants, accountants, tax fees, legal fees, office and administration, often less now because offices are getting smaller. And then depreciation. So what depreciation means is it is recognizing assets that you've purchased. Actually, I'll use an example. Say you bought 20 laptops. You wouldn't put 20 laptops in here because it would look a bit crazy. And also because the benefit of those laptops is over a long period of time. You don't buy 20 laptops every single month and use them. You use them over a useful life. And in general, computer equipment is expected to be useful for 3 years. So depreciation would be 1/36 of those purchases. So if you bought 20 laptops on day one of the business, then this would be 1/36 of those laptops. And every time you buy a big piece of equipment or a website, or any kind of R&D like assets, you would put them on the balance sheet and recognize it over the useful life. So this is what depreciation is. So then you have your cost there, and then you have your operating profit. Now, because I work with startups and scale-ups, and generally I new first-time leaders in startups and scale-ups, this wouldn't be too unfamiliar to you. And that is saying that you're running at a loss. Now, obviously, you work on fundraising and investments so that you can keep running until you get to break even. So when you get break even, that is when this number here is in the black. There's usually bits and pieces in here like bank fees, interest, penalties, taxes, such as corporate tax or R&D tax credits, FX, differences in FX movements, all those kind of bits and pieces. They're usually shown separately. You don't have too much control over those. It's not really part of operations. So as a leader, you would probably just focus on this one and leave that one for the founder and the accountants, because there's not much you can do about those bits and pieces. So everything from operating profit or loss, or you may see this term EBITDA, and that stands for earnings before interest, tax, or sometimes depreciation and amortization. Sometimes this would be below here. So in this example, that would be EBIT, earnings before interest and tax. If you had depreciation here, then you could say earnings before, it would be EBITDA, earnings before interest, tax, depreciation, and amortization. Amortization is just another type of depreciation, just a different asset class. So that's your P&L. So you're looking for the variances to budget. You're looking for both numbers and percentages, give you a good indicator of whether it's material or not. You're looking at how it went from month to month, and you're looking at how it's performing year on year. So where were you? So this, in this instance, this would be January 2024. And then you're looking at year to date versus budget. I haven't put this in because the screen's too small, but ideally you'd have year to date versus budget, so you know whether you're going to hit budget or not. So as a leader, you're asking questions of the reasons for these variances, whether they're legitimate or not, whether the strategy is right or not, and you can discuss as a leadership team as to whether you're going in the right direction. Now, a balance sheet is a very different ballgame. A balance sheet is, even though you get one every single month, the numbers in here represent everything from the beginning of the business, whereas a P&L starts from zero at the beginning of every single month. So this 30,000 revenue only happened in January. This 32,000 only happened in December. Whereas a balance sheet, this is the cash that you have. And it's not just the cash that you received or had to pay out in the month. If you downloaded all of your bank statements, this is how much cash you have. I would say if you're a leader, I'm not going to, I'll probably explain what they are, but I'll let you know which are the ones you really need to focus on. Now, the most obvious one is cash. So you want to know how much cash you have in the bank. It's at the top of the balance sheet. It's also in the cash flow, and we'll go through that, and that's more interesting when thinking about cash. Deposits generally is just cash that is sitting somewhere, so you may need to deposit for an office, for example. It doesn't move much at all year on year, so month on month, so I wouldn't worry about that one. This one is important. So trade debtors means, or trade receivables, same thing, means this is how many invoices haven't been paid. So if you're in the commercial teams and this number keeps getting bigger and bigger every single month, you've got a problem. So either you need to help finance get these invoices paid, or you need to revisit the customers that you're sending invoices to. So ideally, you don't want this number to get out of control. You don't want it to be increasing too much month on month. You want it to be relatively stable. And it's because if you are invoicing these sales and revenues and they're not being paid, then either we have to reverse the revenue in your P&L, which means you're not going to hit targets for that month, or your team, the commercial team and the finance team, are spending a lot of resources getting the cash in. And particularly if you've got a low cash balance, this can cause real problems, because you may be paying, say, for inventory or services up front, but not getting paid for it, then you have a real cash problem. So this one's quite important. Inventory is also important if you have inventory. Again, if you're in the buying team, you don't want this one to get out of control either. It's a real focus for auditors. They love going through inventory. So you need to make sure everything included in here is ready for sale and you don't have too much inventory, costs too much. If you're in the buying team, you probably know this better than I do. Prepayments, that just means things that you've had to pay for up front, but you're not recognizing yet. Perfect example is an insurance policy for a whole year. You probably have to pay for the whole year up front. So we just recognize that a little bit every single month. So that's what prepayments means. It just means things that we've had to pay for up front. This is where all your fixed assets are. So computer equipment, as I mentioned, if you made 20,000 of them and then you recognize them over 36 months, this is where that calculation sits. And it would be the same for office furniture and intangibles. So your IP, your website, goodwill, which means you've bought a company, those type of things. So that you don't need to worry about that one too much. Trade creditors is probably also something worth focusing on. Instead of being invoices that you are owed, it's invoices that you owe. This is your bills, unpaid bills, basically. So if your suppliers are complaining that haven't been paid yet, this is the number that they haven't been. So again, if this starts climbing and climbing and climbing, either you've got cash problems or your finance team isn't doing their job properly. So you need to also just be aware of what that is, and if it's remaining relatively stable month on month, or you've had a couple of big bills and then it comes back down again, you should be fine. But ideally that's what that is. Credit card bill, you get your bill before you pay it, so that's what that is. Employment costs, that usually includes the taxes and pensions and all sort of these sort of things that are calculated on the payroll month, but generally these aren't paid until the following month. So when there's a payroll calculation, generally at the end of the month, that the finance team do, they pay all employees immediately. So that's your payday. But all of the taxes and pensions that need to be paid, that in general, they'll be paid the following month. So that's what that is. It should just be a monthly amount. If it starts getting higher than a monthly amount, again, it means there's cash problems and you are running into some debt. Taxes, most startups and scale-ups outside VAT and sales tax, they don't have anything. But I would say most loss-making businesses may have a negative here because the VAT, GST, sales tax, the government owes you instead of the other way around. You'll see your tax liabilities sitting in there. And then the loan as well. So these are all your liabilities. If you have any debt, loans, that would be sitting in here as well. So these are all your assets. These are all your liabilities. One minus the other equals equity. That's why it's called a balance sheet, is because it has to balance. So assets minus liabilities minus equity should equal 0. Now, equity, the most important thing for you to maybe understand is the first one, current year trading. This is basically telling you your year-to-date number. So across here, it's probably not the same because I've fiddled with it. No, it's not. But essentially your year-to-date net profit or loss number, this one, 32,900, that should be the same, 32,900. Then it doesn't balance, but that's just because I was playing around with figures. So let me just make it balance. This is not proper accounting. But essentially, so that figure there should be the same as this figure here. It's just telling you what your current year profits or losses are. Share capital, that is just what the founders started the business with. Generally, it's £1, £1, 1 share. Share premium is how much the business has fundraised to date in general. There may be other instruments. There may be ASAs, there may be a safe, there may be a convertible loan note. There's lots of different ways that you can raise money, but in a basic model, share premium. So in this instance, the business fundraised £1 million, and that's probably very early stage. And then retained earnings is just saying all the prior years, this is how much the company has made. And as you can see, it continues to be a loss. You don't need to look at that every month because you'll notice this is probably the only number that changes every month. But I would say your liabilities If they're increasing a lot each month, then that's a concern for you. Otherwise, I would focus on these ones as well, your assets. Okay, now if you're still watching, well done. This is a lot of numbers, particularly if you're not a numbers person. So, but I really do hope this is helping you understand the management accounts that hit your inbox. Now, this one, it takes a little bit for you to get your head around, but hopefully I can explain it well enough. This is a cash flow report. So what the cash flow report says, actually, I'll show you at the bottom. At the 31st of December, 2024, your bank statement said you had $949,820 or pounds in all your bank accounts. At the end of January, on the 31st of January 2025, your closing cash position was 885,195. And you can see in the balance sheet, it says the same, 885,195, exactly the same. Now, what the cash flow statement does, it tells you how you went from 949 to 885. And you can see the cash movement in the month was negative 64,000. So if everything that happened in the business, you lost 64,000. Now, this is different to the P&L, and it should be different to the P&L, because the P&L is showing things that you incurred or invoiced or people sent you bills, but it's got nothing to do with cash. This is where the cash is. And it's basically around timings. So all of these things, the bottom half is easier to understand. So it's saying, okay, did we fundraise in the month? Yes, if you did, the amount that you received is in there. Did you raise a debt? Did you get a new debt or a new loan this month? Yes, okay, then the amount you received from the lender is in there. Did you have to pay some of the loan off this month? So it's not in your P&L. Yes, okay, so that amount would be in. This one is saying, so in the investing, this one is saying, okay, there's a negative 1,500 in there. So that means I purchased an asset. Generally, I would say a computer. So if you buy a computer, remember how I said that that doesn't go to the P&L, just 1/36th of it goes to the P&L. That is wise because it goes into your balance sheet in the assets. So it would go in here. And then the cost of that, which is how much cash you had to pay for it, would be in here. So that's how you know how much you're spending on things that go through the balance sheet. So that's why you don't have to worry about this too much. It's largely, you see it quite clearly in your cash flow statement. Now, all of these things, it looks complicated, but basically this means the timing of when invoices are paid versus how many invoices you raised, and on the flip, how many bills were raised and how much you paid. So let's have a look at the first one. We'll just do these two because the other ones can be a heap of different things. So with your trade debtors, say in January, we raised invoices. Let's assume these two are. So these ones just come in automatically. They go straight into your bank account. So that actually might be the same. But these two products, product A and product B, we actually have to raise an invoice for these two. And those two together is 55,000. So in January, you invoiced 55,000. Now in January, you had only 47,000 worth of invoices were paid. So whether that's current month or prior months, your outstanding invoices, only 47 was paid. So that means from a cash perspective, when you're looking at your profit and loss, you have to deduct a further 8,000 from a cash perspective because there's a difference between those two. And as I said, it's a bit complicated, but hopefully you kind of understand. It may take, this might be a good introduction. And then if you want to learn more, if you're really keen, just ask your finance professional in-house and they should be able to help you. Now, the trade creditors is the other way around. So say in January, you received invoices of, let's just say 50,000. But then because you had so many invoices outstanding and some creditors or suppliers were like, you need to pay me early, and you had a bit of a backlog. So then the finance function paid £60,000 worth of invoices. So the weekly or fortnightly payment run that they do, they paid £60,000 or dollars worth of invoices, but they only received 50,000. And that's because you'd have invoices outstanding from prior periods. So from a cash flow perspective, that's another 10,000 hit to your cash over and above what happened in your P&L. So this is why, so when you add up those two things, some bits and pieces there, again, that'll be timing around when you pay the taxes or timing of when you made prepayments or the timing of inventory. There's lots of different bits and pieces. It's basically timing of cash. That's all it is. It's saying the difference between when you're entering something to the accounts and when you actually pay them. So that's all. So if you think about it like that, then that's quite straightforward. And then we're saying if we add up all of those things, so the P&L with the timing differences, plus buying a computer, not fundraising anything, then I've paid 64,000. So my cash balance has dropped. Now, this is what is also called a cash burn. So if you ever hear someone saying cash burn, they're talking about this number. And generally, you look at the cash burn on average over 3 months. And the reason for that is because some things like VAT, GST are paid on a quarterly basis. So it's good to get an average over 3 months to get a proper indication. So if you ever hear investors say cash burn, that's what it is. And then if your business isn't growing like crazy, which if you're a startup or scale up, they probably are, but if they're not, then the closing cash balance divided by your average cash burn gives you your runway. Now, most businesses we work for, they're growing businesses. So using your cash burn as an indicator of cash runway doesn't work. We have to use the budget. So if your business is growing, then I wouldn't use cash burn as an indicator for cash runway because you will definitely be over or understated. So make sure you work out cash runway using a forecast, but it gives you your current day cash burn. So the things that I would be looking at then is the timing of these. So if you see 3 months worth and these are constantly in negative, it means that we're not collecting enough cash from our customers. So that's a real concern. And then the same with trade creditors. Why do we have so much debt? What's going on there? I mean, you may know, it may be that you were holding off paying invoices for a few months. Then you had a fundraise and then you're able to pay everyone again. There may be an element of there, but if it's just red every single month, I would just ask the question. Again, understanding how much assets we're buying. As a leadership team, you should know the drivers for buying assets. Do you have an over-eager tech systems person that just loves new kit? Or is it legitimate purchases? And then obviously fundraising, debt payments, as long as you have an understanding of that, that's quite useful as well. So anyway, so that is a very simple version of a management accounts. Hopefully that gives you a bit of insight so that when you get this on a monthly basis, you can open it and you can understand what you're looking at. But the most important thing is if you have that understanding, that knowledge, then you're going to be able to use this information to help you make the right commercial decisions. This is the most important reason for the management accounts, and it's the most important thing of what a finance person should be doing is giving you the tools, giving you the information so that you can hopefully work with your finance person to give you the insights that you need to help make the decisions together. So the finance function should be collaborative. You should be working with your finance team so that the two of you can make great decisions so that you can hit the strategic goals. So hopefully that's useful. I am doing a leadership team series. So I've got a couple of them now and I'll continue doing a few more just to help you with your knowledge so that we can help you essentially. So if you find this interesting, please hit subscribe and I'll see you in the next video. Cheers.